we all know that, whenever you feel that the stocks or, the index are going to go up, so you can always take a long position. But if you think the market is going to fall or a particular stock is going to fall, you can even short the stock or the index. So here I've taken one more example that is basically on Nifty. Simple example on Nifty, because Nifty there is no physical delivery. Fine. So it's always better if you have a bullish view, then you should always take a long position or short position in Nifty, both in options as well as in futures, because you're always, safe from, the hassle of taking or giving delivery. So basically, again, there is a person who's a trader. You can do also hedging also, but we'll do that later a little bit. Suppose you are a trader and you are speculative, this thing in nature, and you make profit from your positions. So on 1st of January 2024, he wished to buy Nifty. He feels the Nifty will go up. Already it has gone up to a great extent. But of course, if you look at it has gone up, I think 15-20% last 1 year. And most of the, thing has come in the last couple of months. So he still has a bullish view on Nifty. Of course, we say that Nifty will be somewhat range bound before the elections. So Nifty futures February 24. So today we are January. So we have January, February and March, 3 contracts open. So I'll just show you that on the stock exchange also. So there are 3 months on which you can either take a position in January, which is going to close by the last Thursday of January, or you can take your position in the month of February. Okay, if you think that, by February also, the market is going to go up and you will make a money out of it. So you saw Nifty and you found that, last it was trading at 21,963. So this is not the capital segment Nifty. This is the futures Nifty. Okay. So whenever you look at any stock or any index, so there will be a cash market, position. Nifty is trading at certain level, and there will be in the future it will be available at different point. Sometime more, sometime less. Okay. There will be either premium or there will be discount to the cash market. So either we call it cash market or capital segment market. So you find that February futures was trading at 21,963. So before I go there, so look at this. When you open the screen on the stock exchange, you've got this. So there are 3 contracts. So we are looking at National Stock Exchange. Okay, spot rate is 21,741. Say it was early January, and one contract is expiring on 25th of January 2024. Lot size of Nifty is 50. Okay, Nifty 50 we say it. So the other contract is 29th of February 2024, and then the third contract is for the 28th of March. So there is a near month, mid month, and far month. So you can always take positions in 3 months time frame. So the last traded price is given for each of the month. For January, it is trading at 21,830, and February it is trading at further premium of 21,962, and March is trading at 22,090. So it looks that still there are bullish positions in the Nifty. So as we go along, so Nifty is trading at a higher price. Okay, so either you can buy or sell. So there is a, if you see on the right hand side, there is a action is buy or sell. So you can either take a long position or you can take a short position in Nifty. So coming back to this, so expiry is on 29th of February, which is the last Thursday of February. Lot size is 50 of Nifty. So you took a position in 10 lots. So each lot is 50. So that means you are buying 500 Nifty for the February month. So he takes a long position, that is buys 10 lots of Nifty at 21,963. So the name will be Nifty 29 February futures. So it will be, this is your contract name. So the spot rate is 21,742 as on that day. So then you saw on the screen, this was the position. So, but only the advantage is that Nifty, there is no physical delivery. Index options or index futures, there is no physical delivery. So just to say, this is the first screen we did. So he takes a long position in Nifty, and then he sees the screen, so he buys. He puts an order of 500 Nifty, and Nifty he punches the order for limit order at 21,962. Okay, that is the last traded price. So so he puts the last traded price was 21,962. So you can put a market order or a limit order. You can put even lower than what is up. Currently trading. If you think that the market may correct a little bit, so you can even place at 21,950 or 960 or 955, whatever. So he takes a position. Now, when he punches the orders, we find that he has to pay 12,83,698 as margin money. Okay, so you have to deposit a margin before you set the trade. Then, so he has to pay a margin for the stock exchange. Margin is 12,83,000. So it works out to be 11.69%. When you multiply, the total value of Nifty, 21,963 is the Nifty's future price. 500 is a lot, 50 lot size. So 10 lots. So it comes to 1 crore 9 lakh 81,000. So your exposure is to the extent of 1 crore 9 lakhs 81,000. And you're supposed to pay 12 lakh 83,698. So we'll understand, there are two components of the margin which you have to pay. That we'll understand when we do the theory. So that one is called the, span margin. Another is called the extreme loss margin. So we'll understand that. And we'll see how to calculate. But the total margin is this. This is the price. Either you can sell it or you can buy it at the same price. It's not for buying and selling will be different price. It will be one price. Of course, there will be, you can go to the bid and offers, which I have not captured here. So you'll find, हमने देखा है बस वो आपको है, but price will remain the same. Whether it is you want to short the Nifty or you want to take a long position or short, the price is the current Nifty futures. The price is not going to change whether you want to short or whether you want to take a long. So then you pay this margin, and what happens that after some time, so you took this position sometime early January, 1st or 2nd of January. So on 15th of January, on 15th of February, so almost more than a month, you find Nifty future is trading at 22,100, and you have taken your position at what point? 21,960. So you're sitting on a profit. So he's making a profit of how much? 137. This thing. So he's making a profit of 68,500 on 15th of February. Of course, the expiry is still very far. Okay, on 29th of February. So he has made a profit of 68,500. So he thinks that it's good. I should, book my profit. So he wants to book his profit. So he squares off his position. So whatever position he has taken earlier, long position, he'll be taking a short position so that the position will get closed, squared off. So by taking an opposite position, selling Nifty futures at 22,100 in the same month contract, that is 29th February. So you have to take, whatever position you have taken in January or February, you have to take the same, opposite position the similar month. Then only your contract will get over. So his original position will get closed if he does that. So margin will be released. So he has made a profit. Let me just complete this. So he has made a profit of 68,500 on an investment of rupees 12,83,000. That was the margin money he deposited. So he has made a return equivalent to 5.34%. Just give me one more moment before you ask the question. So, okay, yeah. Now, please ask your question. If he doesn't get a buyer, then he has to wait. He punches the order. Okay, suppose he has put a limit order. That only the situation when he may not be finding a buyer. Suppose he has put a higher price. Okay, suppose Nifty was, trading at 22,100 he found, okay? But he wanted to sell at 22,200. And he believed that, during the day, the market may touch by another 100 points because the market was rising. So he may not find the buyer immediately, but he has to wait. So he'll wait up to 3 o'clock, 3:30 the market closes. So then he finds that the market is trading at 22,150. So he immediately, modifies his order and sells the Nifty at 22,150. And because already there are enough buyers at that price, so the chance is that it will be executed immediately. When you sell it at the market price, the order gets executed. Maybe at 21,150 or 21,049 or whatever. Okay, so 1 or 2 rupees here. Not spot. This is the future price. This is the future price at which the trade is happening. Spot price is separate price. Okay, now we'll talk about the spot price also. So whenever you are closing your position, anywhere mid of this thing before the expiry, then your position gets closed with the future price of Nifty. Okay, but what will happen on 29th of February? You have not closed your position. Suppose then the Nifty capital market segment price, which is the cash price of Nifty, will be treated for settling your profit or loss. So on the expiry, the Nifty futures and the Nifty spot, they become one price. Okay, but only during there is a gap between this thing. So I'm going to explain that in theory. Okay, so don't worry about it. If you make profit, so it's a short-term capital gain.
Short-term capital gain.
Yeah.
15% price.
नहीं वो generally, this is a speculative market, okay? So for speculation, I mean, of course, we'll understand the income tax. Will just leave it at otherwise there's a 15%. If you sell your stock within 1 year, okay, then you are entitled for 15. You have to pay 15%, okay? Otherwise, you have to pay 10%. You're saying that, okay? Fine. So yeah. So we are not. We'll mix up. We'll come to the income tax part later on. Okay. So let's not confuse that. But it is 15%. At the moment, you think it's 15%. Let's stay with 15%. Okay. Yeah. There is no physical delivery because stock Nifty की delivery हो ही नहीं सकती ना. What is happening is that Nifty is trading fine in the futures market. So you are taking a position on the index. Okay. If the index goes up, you make money. If the index goes down, if you take a long call, you will make a loss. Absolutely, and it is also used for hedging also. Suppose you have a portfolio, okay, and you want to hedge your portfolio, okay, and the portfolio is large caps, fine. So the benchmark is Nifty for that, okay. So you think that your portfolio will go up, go down because of the correction, okay. So you short the Nifty. I'm just giving you before that. What you'll do that if you're holding a portfolio of say 1 crore rupees, okay, and you believe the market is going to correct by 15% during the election time, but you don't want to sell all your shares, fine, because selling the shares and again then buying again, it's a big hassle. There is a transaction cost involved. But because you are long term, you are bullish on Nifty, on your portfolio. So what you do, you can hedge yourself by taking a short position in the Nifty. What will happen when the Nifty goes down? You make money. So whatever money you make, that will offset the losses of your portfolio. Absolutely. But I'm saying is that, so you have to match with the beta. Okay. Suppose your stock portfolio beta is say 1.5. So you will be actually shorting 1.5 times the Nifty. Okay. Fine. So there is we can always, make it perfect hedge also. Fine. You don't short Nifty. You have to actually, align your portfolios because the Nifty beta is 1. Okay. And your portfolio beta is say 1.25. So you have to make an adjustment. How many Nifties you have to short so that you become a perfect hedge. So we'll talk about that. Okay. No, only the beta. Yeah. Beta only. Okay. So Nifty now what happens on 29th of February 2024? So it's gone. On 29th February the Nifty is trading at 22,070 in the cash segment. This is the expiry day, cash segment. It's not a future price. Okay. So he's making a profit of 53,500. So one option was he would have closed and made a profit. Okay. Suppose he has sold 5 lots now, he's still left with 5 lots. So he can sell it now, the remaining lots. So, and then the margin will be released and he'll be making a return, which will be now less because had he actually, closed his position before, he would have 5%, now he's getting 4%. Is that okay? Fine. So this is one example of Nifty. So now we move on to some theoretical